Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending on May 21st, 2021. I'm Preston Brent, and thanks for tuning in. Well, this week's theme is the yo-yo markets. I think we're long on the string and short on the yo-yos. I'll explain that in a minute. But first, let's just kind of take a look at what's happening in and around the markets this past week. So if we come over here, and we'll take a look at some of the sound bites, and let's take a look at some of the index performance here. You can see, again, except for the Nasdaq, everybody was in the red, but just barely. Year to date, everybody's in the green. Best sector for the week was real estate. I didn't spell that right, but it's real estate sector. The worst sector is energy for the week. You can see the sector performance year to date. Energy still bringing up the headline news, outperforming everybody else, making up for a really bad 2020 year. Technology is bringing up the rear. We're seeing money come out of the tech sector and into more value-oriented companies. And you'll see that when we take a look at the Dow, which has got a lot of value mega cap companies located in it. You can also see that the PE ratio going forward, 22.42, is still a very elevated PE ratio in my mind, but we can be there because interest rates are fairly low. Dividend yield on the S&P is at 1.38, and the 10-year Treasury closed the week out at 1.62. So that gives us this 24 basis point spread, almost a quarter a point higher in the Treasury over the S&P, but it's still tight enough where money still needs that extra yield. So it's going into the equity market. You can see the VIX moved up 20% over the week, almost 21%, closed out at 20.15. So the markets are very nervous right now. We've been back and forth, and it's really kind of difficult to do swing trades, 1, 2, 3 week trades, because you're going to be in profits one day and out of profits the next. Okay. We've seen it's basically a mixed market. Okay. We did have minutes from the FOMC this past week, which kind of showed policymakers, a lot of the Fed mucky mucks at the Federal Reserve. They begin discussing plans for tapering the Fed monthly asset purchase. That would be QE. So that kind of was a little bit more hawkish than dovish for the FOMC meeting minutes. I kind of caught the markets a little bit off guard, pulled it back a little bit. I think what's going to happen, we got a big Fed meeting. In fact, central banks all over the planet are going to be converging on Jackson Hole, Wyoming in August. And I think they're going to come out with an announcement that they're not just thinking about, but they're talking about and planning how they're going to reduce QE. Okay. That would be the monthly amount that they're spending. They're spending 120 billion a month, 80 billion of it on treasuries, 40 billion of it on mortgage-backed securities. So we're going to see some of that play itself out. And I am still calling for a 10, anywhere from an 8 to about a 12% pullback sometime in June, July, August. I think we could get a little bit of a bounce in the month of June, kind of a relief rally, even challenge these all-time highs, even possibly go higher. But then I think we're going to see some ugliness come up towards the end of the summer or in the middle of the summer. So guys, you need to be ready. Members, we'll go through some really cool, interesting option plays here. I got a bunch of them to show you guys this Sunday in our weekly market watch. And these will be plays that you guys will be able to make whether you got a 5K portfolio or you got portfolio margin. All right, it's going to be really interesting for you. Anyway, that's kind of what we got on that front. If we look at the economic data that came out this past week too, we saw that the U.S. Composite PMI, Purchasing Managers Index, came in at a record 68.1 in May. That's a huge improvement from April's 63.5. Okay, the service sector component was also very strong, coming in at a record 70.1 from 64.7. Okay, so we're seeing the overall manufacturing sector advance to 61.5 month over month from last month 60.5. So net with all these numbers, manufacturing is coming back very strong, but you know they're trying to catch up with demand because consumers are spending like wild bugs. So they're trying to order and get the stuff in. That's creating the inflationary effect because we got problems with the supply chain. I go through some of that with you, with our members for our weekly market watch this Sunday evening. But net, we're seeing this rate of input price increase surging. Really, input meaning input to the materials and supplies and components that manufacturing have to buy to put together to sell to folks like us, surging to a record amount. It's the sharpest rise since October 2009. Okay. So it's going to be real interesting to see how this stuff plays itself out, right? Now, if we come over here and we look at treasuries, as I said, treasury yields were roughly unchanged for the week. We've got strong demand from Asia. They're still buying a lot of our investment grade corporate bonds. We're also seeing with interest rates very low, one of the largest buyers of MBS, mortgage-backed securities, are banks. They're on average buying 44 billion per month. And if you think about it, banks essentially they're deposit rich, and they're hurt on loan growth. They're having trouble getting loans out there, right? So they need to increase their yield, because without the loans, they don't have that net interest margin spread. So they're going out and they're buying a lot of MBS, and the credit spread in the MBS market compared to treasuries is extremely tight. The minute the feds come out, I think my estimate is in August in Jackson Hole, Wyoming, and start talking about a plan for QE reduction, you're going to see those spreads widen, okay? Which means higher interest rates for mortgages, housing, community, everything. So we're going to see all of this stuff start to come to fruition. And that's going to give us our pullback that I'm looking for, anywhere from 7-8% up to maybe 12% or so in the equity markets this summer. Now, that's from a U.S. Treasury standpoint. If we come over and let's take a look at Europe, and let's look at the Europe indexes, you can see everybody, a little bit more of we had more green across Europe. The Euro stocks up 21 basis points, CAC 40 and DAX both up also. The FTSE was down just a little bit, but year to date, everybody's in the green across Europe. And you can see in the Asian markets, the Nikkei, the Japanese market, Chinese market, and Hang Seng, all year to date are in the green, although China just barely so. I mean, China's barely in the green on the index that I'm tracking here. So we've got to be careful here. Although China, you would think China, because they're blowing out their numbers, they're blowing out manufacturing data, they're blowing out retail sales, blowing out auto sales, and you're like, okay, why are they so poor, performing so poor? And that's because they're doing an attack on the technology industry. They don't want tech and social media companies in China to have access to taking money and doing financial transactions, so they're limiting that. Also, they've come out and they've started cutting stimulus. China's, ahead of the game there. They're trying to build value in the yuan. I think secretly they're buying gold to back it with the yuan. They're also testing the digital yuan, and we're finding that the feds here are coming out testing the yuan. Here are testing the digital dollar. Same thing in Europe. So you're going to gradually see a transition over the next decade or two. And the Feds basically said, Boom Powell came out, our illustrious Fed chair, and said, we want to lead the way in the digital currencies of the future. So by doing that, I think it's going to damage crypto a lot, because then crypto is going to be competing against the Fed and the central banks in Europe and US. And they got the power. I mean, look at what China did. I mean, if you look at cryptos this week, they've been batshit crazy to the downside. Primary reason, the PBOC came out this past week. In fact, over the weekend, they started it off. They fired the warning shot by saying, we don't think financial institutions in China should accept Bitcoin as a financial transaction and a store of value. We're against it. Now, they haven't officially banned it, but they're suggesting strongly. So that just started crypto selling off big time. And then some tweets came out with Elon Musk about crypto. But it will not surprise me at all to see, once the US and Europe get into the digital era of currency, where they can track everything that you do, eliminate crypto. The other thing that came out, it was in this big fives, this white paper by 53 large institutions that are trying to push this digital currency. There was a big white paper that came out that said one of the things on cryptocurrency is it's leading to more ransomware, where companies are being sued, or basically like what we did with the Colonial Pipeline, or what we saw happen with the Colonial Pipeline, where foreign state actors or malicious companies come in and shut down business websites. Once they're shut down, they declare a ransom and they want the money, and then they get paid again. And all of that can be done because you can't track crypto. So I suspect the government's going to put a hold and a stop on that too. If it happened, and notice most of the companies that are getting ransomed out are not in China. They're not going to ransom out those, because China will just block crypto altogether. So, and then you're going to see that though backwash over to the shores of Europe and the U.S., and that'll be one way to put an end to it. If you just outlaw crypto. Now, I don't think they're going to go that strong. They'll probably come in initially and say things like, we want, the old quote unquote know your customer routine, like banks, where they're going to identify every customer with a crypto account. All these exchanges that do this. Now, blockchain makes that very difficult. So the next step would be eventually the elimination of crypto. I believe in blockchain technologies and what it can do for financial technology or fintech, but I think the crypto community, if they're not careful, it's not going to be a store of exchange of value. It's longer term. Short term, you're sure it's fun to play, but that's kind of what I see happening right now. So that's kind of what we see going on over there in Europe. We got strong data out of Europe, right? Shares are up, business activities accelerating at the fastest pace in 3 years. The PMI data out of Europe is also going up dramatically, all over 50. I think it was 56.9, the PMI across Europe. UK consumer prices, like we saw here, huge rapid increase in inflation. All right. So understand the CPI data here in the U.S. excludes, core CPI excludes energy and food, which, as we all know as consumers, is a big part of our day-to-day and week-to-week costs. But the Feds, they jury these numbers out. But one thing they can't, a lot of people don't realize, you know what a third of the CPI is made of? Rent. Rent increases is going to drive CPI, and I see rent increases coming on down the road, and that's going to jack CPI up. So the debate on is inflation transitory or permanent, I have said here on record that I think it will be transitory, but it's not going to go back to the way it was before, and then it's going to take off again. That's going to cause the markets to react both to a pullback and then a final run higher, and then the highs will be in, and then we'll have a bear market coming up sometime in late 22, 23. That'll be 40 to 50% drop, right? So that's kind of what I'm seeing in the charts and the way things are lining up right now, okay? If we come over, and what I want to do is just kind of shift the screen a little bit. One other thing with China, same thing with China. They got huge, strong demand. Okay, they're shipping as much as they can. There's a shortage of containers, which is also making that goose egg in the pipeline bigger for the supply chain. But they're trying to alleviate all that. Right now, it's more demand issue in the supply chain rather than supply issue. So we're seeing that increase in rates and prices. But once the supply is able to catch up to demand, we'll have, like I said, a momentary pullback in inflation. It'll settle in at a higher rate, and then we're going to start to take off again. All right. Already the Fed Fund Futures is pricing in the first rate hike. They moved it up by almost 6 months. The original first rate hike in the Fed Fund Futures was forecasted out to Q4 of 2022. Now they moved it up to Q1 of 2022. Folks, that's, 6 or 7 months from now. And I'm talking rate hike, not end of stimulus or QE rather, rate hike. So if inflation starts to take off anymore, it's going to challenge the Feds, and it's going to be interesting to see what they do. Okay. And just understand that the first whiff of a rate hike or any stimulus reduction. And keep in mind, even if they cut back stimulus or QE every month from 120 billion to 100 billion or whatever they do, it's like a rate hike. Now, what they did before when they were cutting QE back down to zero, they would do 5 billion a month or 10 billion, and then they'd raise it to 15, and they'd raise it to 20. And they did it over a 1 year period. All right. So we should expect something like this again. Remember, they're spending 40 billion a month in mortgage-backed securities and 80 billion a month in U.S. Treasuries. And as they cut back, they may shift. They may move out of MBS because I don't think the housing market needs any support, quite frankly. There's enough demand for houses. In fact, the material cost of lumber and other building supplies has gone through the roof. So it's kind of creating this supply chain issue of getting enough materials to finish houses. So there's more buyers than sellers. So it's a seller market right now. I advise all my buddies down here in South Florida to cash out while you can, because it is a seller market. You can buy here. It's going to cost you 20 or 30% more for a new home here than it did just 4 or 5 months ago. It's insane. Buy, go to cash, wait, because I think you're going to have a 20 or 30% haircut in all real estate prices in the next couple of years. And I think you'll be able to buy the same property for 20 or 30% cheaper. Granted, the interest rates will be a little bit higher, but not enough to offset that big cost differential that you're going to get by waiting it out and just taking the cash and investing it in the markets. So what I want to do now is just to take you over to the charts. I'm going to swing over. So let me just bounce this over like this. Let's come over here like this. And I'm going to show you the E-mini S&P 500 futures. Now let's just take a look. Kind of what I'm seeing here in the markets. Let me just end this thing right here and we'll bounce it up. Take a couple of seconds to paint on the screen for you guys. Okay, so you guys should be seeing right now the S&P 500 E-mini futures. You can see how it's holding the 50 EMA. And if we go below the 50 EMA, we're only down below it. This is a daily chart for just one day. And then it bounces back up. And we've had numerous tests, but so far it's holding. And we got a cross in the MACD moving up. We had another test, but we closed intraday above the 50 EMA. We went below it, but we closed up. We're fairly close to the all-time highs. It's been a very choppy period here, okay? I mean, if we go back in time, back over to middle of April to where we are now, just past the 2/3 mark of May, we're almost at the same price. So we've gone up, we've gone down, and we kind of arrived at the same price. So we haven't really gone anywhere. We've had that little scare when CPI came out really hot and heavy, but the markets quickly reacted to the overreaction to the downside. So now we're sitting here like this. Where do I think we'll go? I think we've got more upside left in the markets near term. Like I said, I'm still looking for a 10% pullback, maybe a little bit more. If I take my little drawing tool here and just kind of show you what that would put us at. If I go to 10%, it takes us just slightly above the 2020 closing price. If I take us right down to the first fib node, which is what I would expect, that gives us about 11.4% pullback. To me, that would be a good target to shoot for. Notice we got our fib node sitting right on our 2020 closing price next to also a key price pivot level, and then our 2021 low print, which was in earlier in the year, is in February. So all of this here is going to serve as support for the market. So this is where I think we're going to wind up sometime in the summer months going into September. And then once we see buyers come in, it's going to come in very strong, and we should have a strong finish to the year carrying off into 2022, okay, as we start to get earnings out. But I do believe we're going to get the scare the children moment here. And as I said, we're going to be we're going to be long string and short yo-yos. It's going to be kind of crazy on our way down. It'll scare the children, but that's kind of what I'm seeing that we're going to do here. Notice the 200 EMA, where we're well north of, is sitting right in this zone here, right? Is the yellow line. So again, I think we're going to test that this summer, and then we'll have a nice run up from there. But so you want to be able to approach this downdraft either short or with a lot of dry powder, because there's going to be great buying opportunities here. Okay, members, Sunday night I've got about 4 or 5 different stocks that I'm going to show you some really cool option plays that we can put on these things, and they're longer term plays, so it'll allow us to play this to the downside and really go long these guys when this thing starts to bottom here. Okay, so that's kind of what I'm seeing now. Keep this chart in mind. We've had multiple tests of this 50 EMA. We actually went below the 50 EMA over here, but it was only for 3 or 4 days, and that was back in November of 2020. So this has been a very strong support point. Now, if I show you the Dow Futures, let's go take a look at the Dow Futures. Look at this, guys. We're testing the 50 EMA. We haven't broken it as much as the E-minis. And you can see here about the same. Fairly strong. We're going to get a cross in the MACD, probably above 0. The E-mini S&Ps are below 0 in the MACD. But I think we're going to get a cross up, and we're going to challenge these as well. So the Dow is actually performing very nicely right now. Okay, I mean, they're doing very well year to date. And now if we look at the Russell, it usually is a leading indicator of where the rest of the markets are going. And look at the Russell. We're actually sitting just slightly below the 50 EMA. We're below this upsloping trend line, and we have gone nowhere, going all the way back to this key price pivot on the 25th of January of this year. We've literally gone nowhere. Now we're well north of the 2020 closing price, so we're well in the green, but we are just, you know, on a ship to nowhere. It's just not doing anything. So this tells me that money is rotating in and out, going from mostly from growth into value. And just look at this chart here, and then I'm going to show you the Russell 1000 value. These are value stocks, smaller value stocks. Check this out. That does not look like the Russell Futures, does it? This is just Russell value, which the ticker is India Whiskey David. This is more strong. So I think you're going to see an outperformance of Russell value over just the generic Russell or Russell growth, right? So these are things that I'm starting to see that are telling me that the markets could be nearing or around the apex. Remember the way the markets have a topping process. It is the actual top of a market before a bear market truly is a topping process. It can string out for over a year. Okay. Bottoms are not really as much a process as they are a point in time. They have sharp rallies off the bottom, and then they may have a retest of the bottom or another lower low, giving us a bullish divergence, typically an Elliott wave 5, and then we have a sharp reversal, and then we don't see those bottoms again. Tops, though, can take a long time to form in the markets, which is what makes it a little bit more difficult to trade. But one way we follow that is the breadth of the market underneath. Members will go through the breadth of the markets tomorrow evening, okay, in our weekly market watch, and rotation. And if rotation can be strong enough, then we can see, even though we come out of tech and we have a pretty good pullback in technology, we still have enough rotation in other stocks that it keeps the markets elevated. But it doesn't last very long. And then eventually we get that rollover. Right now, because earnings are very strong, as long as earnings in companies outpace the growth in inflation, we'll be fine. But keep in mind the year-over-year comps are very easy right now. Q2, the year-over-year comps will be even easier. You thought you had blowout earnings in Q1. Wait till Q2. It's going to be just through the roof. So I think that'll give us that goose after we get through this dip, and then buying is going to be like a buying frenzy. You guys want to take advantage of it. But then after that, the year-over-year comps are going to be very hard, and then you're going to see a lot of companies' PE ratios coming down. They're already taking the PE ratios down of tech. If we look at tech, this is a customized index I've made of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. You can see here we're just sitting just slightly above the 50 EMA, but it's just barely, right? And you can see the movement off these highs here. And it's very difficult trade-wise because we're wide swings both up and down. Now, these are mega cap tech. They're going to fare better than others, but they're still pulling back, okay? Because their PE ratios just got insane. If we look at Nasdaq 100, you're going to see the same thing. It's sitting right on the 50 EMA, okay? So and look how close we are to the closing price. We haven't really gone anywhere. And it looked like at first it was trying to do a head and shoulders, but a technical pattern, but it hasn't. We're just running sideways right now. I still think there's going to be enough oomph in the gas tank to take out these highs, because we're not going to have Nasdaq going into the red with the rest of the market making new all-time highs, because there's just too much weighted value with these FANG stocks and others. They're about 25% or so of the S&P value. So if these get crushed, S&P is going to have a hard time making new all-time highs. I don't think they're going to get crushed, but they're going to be under duration over the summer months. If we come down here and we look at volatility, let me just see here. Where are we? Here we go, right here. Hang on one second, guys. I'm gonna mute you just 1 second. Okay, I'm back with you here. Let me just get in here. Let's take a look at the volatility. You can see here with the VIX, we're in the yellow zone. I got to add the colored signs here to get us back in so I can show you the VIX in a colored way. With each range, different color, all the way up to black swan. But you can see here the movement. And you can see just how volatile it is. Just this past week, we were already up almost just slightly under 30 in the VIX or under 29. So it's been bouncing around pretty good, guys. And if we come over here and look at treasuries and we look at the bond market for the week, interest rates have actually, the reason why the markets were able to finish a little bit strong is if you notice the bonds over the last 3 days after that inflationary scare on the CPI data in the middle of the week and others, you can see here that the bonds have slowly crept up a little bit, which drives interest rates a little bit lower. Now, what's going to be interesting is if we do get that 7 to 12% plus pullback in the summer months, watch bonds. I think it'll probably come up here. Interest rates will go back down again. The markets will look at that pullback as a reason why the Feds don't need to reduce the QE or any stimulus anytime soon. So you'll see interest rates go lower, you'll see bonds go higher. But once that clears the deck and markets start screaming higher again, you want to be on the short side of the bond market or the long side of interest rates. That's going to be another great play coming up for us, that a lot of different ways that we can play this. Okay. If we look at the US dollar, one of the heaviest shorted areas right now, you can see here it's sitting right on the 2020 closing price. So it's just barely in the green for the year. Okay. Anything north of the 50 EMA, we want to look at shorting. Now, if we get that scare this summer, if they do something, if they announce something out at the Jackson Hole, Wyoming conference for all central bankers, kind of the muckety mucks get together to, do what they need to do. We'll get the dollar running up because you'll see a flight to safety in the US dollar. But as soon as things clear up, it's going to roll back over again. So longer term, I would want to be long euro, short dollar. Okay. So that's just another one that we're looking at there. And then finally, if we come down and look at gold and silver, we want to be longer term. Look at this. I have always said you want to be long gold, but let's wait until it breaks out of this 1815 area. Now it broke out, it did a retest, and off it went. So that was a good place to enter for a long. Members, we got some really interesting trades going on in silver and gold, or starting to play out some option strategies that will let you play it longer term, either in the options on the futures market or using the ETF if you don't want to do direct gold futures. And I'll review that with you guys this Sunday evening as well. All right. And if you got a smaller account, you'll still be able to trade these things. So it'll be fun to trade. All right. If we look at copper, you can see copper pull back this week. Okay. Right in this area here. This is just, we had this big, huge bounce off this trend line. Now it's just resting up. We'll probably find support somewhere here. And then the next big move up is going to come back up and make new all-time highs with copper. Copper is just, to me, a longer term, especially with the infrastructure build out. If they come up with some kind of deal on infrastructure, copper is going to be very strong. If we look at oil, in the futures market, you can see oil here. Remember what I've been saying. After we had this first 2021 high price back here in March 8th exactly, I said, let's fade this move and then let's trade range bound. So I've said between 70 and the high 50s, I just don't see oil getting outside that range short term. So unbalanced condors, unbalanced flies, leaning slightly bullish, but like that are just home run trades, just collecting premium in the oil market. Okay, the oil futures market's great because you get a lot of premium in it. You don't need to trade a large position size to be able to do it. There's other ways to play this. Obviously, if you don't or cannot trade futures on your platform, or you're not permissioned to do that, I'd highly suggest you get permission to do that. Check out some of our videos on it. It'll help you out a little bit. But otherwise, great trades in those areas. Now, we've got some really interesting plays going on in ag and meats. If we look at the softs, take a look at lumber, guys. That is a huge move off the lows. Now, what I want to see with lumber before I'm willing to pull the trigger on a short, and we may not get the trade, I want to get a bearish divergence signal. You can see lumber gapping back up again. I think eventually it's going to get back up near these highs. We're going to set up for a divergence, and then that second high right here, or if it gets close to it, is where I'm going to want to short it. Okay. Now, you can short it just by doing the lumber futures, picking up a short in that. But you got to have a larger account to do this because this thing moves a lot. I mean, we went from 1714 to a low here of 1201. That's 500 points in the futures market, folks. That's huge. It's a lot of money. And you can trade options on it in the Thinkorswim platform. In IB, Interactive Brokers, you can, but the commission, the margining cost is going to jack it up just because it's so volatile. Okay. So these are just some of the things that we're looking at here in the markets. Members, I will see you this Sunday evening. We got some stocks and some option strategies I'll just lay out for you guys that you guys can use to play some of these stocks longer term. All right, everybody, have a really great weekend. Sun out here down in South Florida, so I'll probably go out to the beach, just kind of hang out here and chill and have a good weekend. You guys do the same. Otherwise, members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao.